Why are some of the wealthiest real estate investors suddenly selling their properties and buying Bitcoin instead? The answer might shock you, and it has everything to do with a fundamental shift in how we store value. Today we're breaking down a conversation from the TFTC podcast with Leon Wankum, a real estate developer turned Bitcoin advocate who's been warning about a massive change coming to the $300 trillion real estate market. Leon's unique perspective combines generations of family experience in real estate development with deep expertise in Bitcoin's impact on traditional store of value assets. We'll explore how Bitcoin could cause real estate to lose up to 90% of its value, examine the evidence that this shift is already happening, and understand what this means for the average homeowner. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. Let's start with Leon explaining how he first noticed this trend, as wealthy investors began quietly shifting away from real estate.
It's just that simple, in my opinion, because I can see what's happening around me. People are going bankrupt left and right, and things are going to get worse. I think because Bitcoin is just such an accessible store of value. And just think about conversations you have. Conversations I had 2-3 years ago, people would come up to me and they'd say, Leon, I saved some money and I want to buy real estate. What would you recommend me to do? I'd always say, buy Bitcoin. I always said that, and people said, you're totally nuts. And I want to have a secure store of value.
This shift Leon describes isn't just random market movement. It's the beginning of what could be the largest wealth transfer in history. Through my work at 1031, I'm seeing exactly what he's describing. Established real estate investors quietly starting to question their traditional investment strategies. Why? Because they're noticing their properties aren't protecting wealth like they used to. When Leon mentions people going bankrupt, he's highlighting the first signs of a fundamental market change. The real estate industry is operated on a simple assumption. Property values will always go up because they're a reliable store of value. But Bitcoin is challenging this assumption, and that's exactly why we need to understand what's actually giving real estate its value. What's particularly fascinating is how this mirrors other historical wealth transfers, like the shift from agricultural land to industrial assets during the Industrial Revolution. Back then, landowning aristocrats who didn't adapt lost their wealth to industrialists. Today, we're seeing property owners who don't understand Bitcoin's role in this transition facing similar risks. This isn't just market speculation. It's a structural change in how society stores and transfers value. Now let's hear Leon break down exactly what gives real estate its current value through what he calls the monetary premium.
Well, it's difficult because you asked earlier, you were talking about the monetary premium that sits in real estate. And what is meant with the monetary premium is there's a utility value in housing. You can live in it or you can rent it out. You can use it for production or you can use it for agricultural capacity. But today it's used as a store of value. So it's used as money. So the money that's invested in real estate, not because of its utility value, but because it's a scarce asset that is used to hedge against inflation. That is the monetary premium that you alluded to. And it's difficult actually to say how high that monetary premium is. But I was looking into the cost of real estate, prior to the fiat system. In the 1940s, the average price of a home in the US was around $4,000, right? Today, it's about $530.
Here's where we get our first clear answer about how Bitcoin could cause real estate to lose most of its value. Leon introduces a crucial concept, monetary premium. In simple terms, there are two parts to a property's price: what it's worth for its actual use, living in it, renting it, farming it, and what it's worth as a way to store wealth. This second part, the monetary premium, is what's at risk. The jump from $4,000 houses in the 1940s to $530,000 today isn't just about inflation or better building materials. It's because real estate became our society's primary way to store wealth. But now that Bitcoin offers a more efficient way to store value, this massive price premium could disappear. What's particularly interesting is how this pattern repeats throughout history. Assets that serve as stores of value tend to carry massive premiums until a better alternative comes along. Gold experienced something similar when paper money backed by governments became the global standard. The difference now is that Bitcoin isn't just another form of money. It's technically superior in every way to real estate as a store of value. It's more portable, divisible, verifiable, and impossible to counterfeit. What Leon is about to explain next shows us just how massive this transition could be in terms of actual market value.
I mean, real estate should be between 5 to 10% of what it is now. Maybe 15 to 20%. So, and Bitcoin should be 300 to 600 times larger than it is today, in my opinion. So Bitcoin is a 300 to 600 trillion asset, because if you think about the money that also sits in bonds, the money that sits in art, the money that sits in golds, I mean, the money that sits in equity will most likely continue to sit there, because equity, next to being used as a store of value, they have an investment component. So I'm not going to talk about the money that sits in equities, but I personally believe that the money that sits in bonds, the money that sits in real estate, or most of the money that sits in real estate, 80%, the money that sits in art as well, and the money that sits in precious metals, that should really sit in Bitcoin.
Now we're getting specific evidence of this shift already happening. Leon isn't just theorizing, he's showing us the math behind how value flows between assets. When he talks about Bitcoin absorbing value from bonds, art, and real estate, he's describing a process that's already beginning. Real estate investors, particularly the wealthy ones, are starting to recognize that property isn't the most efficient way to store value anymore. They're seeing how Bitcoin, being digital and perfectly scarce, can do the job better. This isn't just theory, it's happening right now. What's particularly fascinating is how this shift could accelerate. Unlike previous market transitions that took decades or centuries, the digital nature of Bitcoin means this change could happen much faster. We're already seeing signs in markets like China, where wealthy investors are looking for alternatives to real estate as their traditional store of value. The global nature of Bitcoin means that once this shift starts accelerating, it could move much faster than many expect. But this raises an important question. What happens to real estate prices when this transition is complete? Leon's about to give us a detailed breakdown of what the market might look like after this massive transformation.
So I could say, real estate should be a 10 to 30 or 15 to 30, maximum 40, $50 trillion asset, because there is still, if people are wealthy and they want to acquire a house and they subjectively are willing to pay a premium because of its location, for example, on the beach in Miami, they will do that. So real estate will still be expensive in certain locations, but Bitcoin should be a 300 to 600 trillion asset. And real estate should be a 15 to 30, maximum 40, 50 trillion asset. 40, 50 is a lot, right? But 15 to 30 sounds more reasonable, in my opinion, if you talk about the utility value of real estate.
Here's the concrete answer about real estate's true value without its monetary premium. Leon suggests a future where real estate prices reflect actual utility rather than wealth storage. A beachfront property in Miami will still be expensive because people value living there, not because they're trying to protect their wealth from inflation. The overall market could shrink from $300 trillion to $15 to $30 trillion, a massive reduction that would actually make housing more affordable for its intended purpose, living in. This isn't about real estate becoming worthless. It's about returning to rational prices based on actual use value. For homeowners, this means understanding that your house should be viewed primarily as a place to live rather than an investment vehicle. What's particularly interesting is that this transition could actually lead to better housing overall. When properties are valued based on their utility rather than their ability to store wealth, developers would need to compete on quality and functionality rather than just location and scarcity. This could lead to a renaissance in architectural innovation and building quality as the market refocuses on what actually matters, creating excellent places for people to live and work. Will Bitcoin's coming disruption force real estate developers to focus on building quality over speculation? Let me know in the comments. I read every single one. And if you found this breakdown of real estate markets interesting, you'll want to watch our analysis of how Bitcoin could replace the Bretton Woods system. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.